Welcome, everyone. My name is Andrew, and I believe this is class number 25 of the July 2026 complete course for the Florida bar exam. This class is brought to you by IBIS Repair Group, where we do repairs and installations and assembly for pretty much anything under the sun. So, after you take your bar exam, if you want to do some improvements to your house, uh, you can hit us up and we'll do that. Just because there's some new students in the class, and I'll never miss an opportunity to shamelessly advertise. This is our website, IBIS Repair Group. My partner built this clubhouse. We do everything. Literally, we do AC, kitchens, bathrooms, electrical, plumbing, outdoor commercial. We do landscaping, literally everything. And when we do stuff, we do it right. So you can hit us up if you have any residential or commercial needs when it comes to repairs, installations, and assemblies and improvements. Speaking of improvements, my goal today is to help everyone improve their skills when it comes to the business entities section of the bar exam. A super difficult subject. So let's start off by playing some Jeopardy, which may include some other subjects because I don't know, it just might. All right, so this must be served within 120 days of commencement unless good cause or neglect is shown.
Commons.
Yeah, I guess the complaint is someone's in complaint. I'll accept that answer. Typically, people say a complaint, but typically they come together, so acceptable. Um, Remember, 120 days in Florida, 90 days in federal, and just because it's not served in 120 days doesn't mean they automatically dismiss. They could show good cause for an extension, right? So must be served within 20 days of the answer. Can someone give me a reply here? You get it? Can someone give me a reply? Because the answer is reply. All right. I'm moving faster than everyone today. So yeah, what is a reply, right? Within 20 days. Motions in Florida are typically 20 days for civil procedure. At the close of evidence, the plaintiff has failed to prove the essential element. At the close of evidence.
Summary judgment.
Um,
A
I think
directed verdict.
yeah, I think summary judgment is at the close of discovery if there's no genuine disputed material fact, where a directed verdict would be at the close of evidence. But it's all right, Nikki. At least you have your emotional support with you.
I was doing it for her. I'm sorry.
You're fine. So this is the appropriate court for ejectment cases between landlord and tenant. For ejectments, right? When landlord is ejecting a tenant. Yeah, circuit court. And then this is the proper court for disputes involving homeowners associations.
County.
County court, right? So make sure you understand county, circuit, Supreme Court. All right. 175 days.
Felony in criminal pro.
Yeah, the speedy trial time for a felony. And remember, they've changed it from the day of the arrest to now it's 175 days from when the charges are filed, right? So time to bring a defendant to trial for a felony. The amount of time a defendant must be brought to trial after charges have been filed for a misdemeanor. Shit.
90.
Yeah, 90 days after charges have been filed. Exactly. They like to test that a lot. What if it's combined? What if it's a misdemeanor and a felony you're
One
charged with?
175.
Right, you get the greater of the two. A criminal offense punishable by incarceration for a period not in excess of 1 year.
Misdemeanor.
Nice. Misdemeanor, yeah. You guys remember misdemeanor Elliott? The defendant's response to formal charges occurs here. I plead guilty. I plead not guilty. I plead no contest. Yeah.
Arraignment.
Arraignment. No contendere. Yeah, an arraignment. Okay. The defendant's response to formal charge occurs here. Also arraignment. I don't know why I asked that question twice. All right. A possible sentence only for crimes involving murder.
Death penalty.
Yeah, the death penalty, right? Capital punishment. Okay. This spousal privilege, unlike the marital communications, is not recognized in Florida.
Testimony.
Yeah, testimonial, right? You cannot refuse to testify against your spouse under the testimonial marital privilege in Florida. You could in federal. Florida does recognize marital communications, but not the testimonial privilege. Good job. This cannot be proved through opinion testimony in Florida.
Character.
Character evidence, right? Reputation only. One of my students, Andres, he came up with the uh, saying, rep yep, ope nope. Reputation can come in, opinion not come in, right? That's different than federal where they will allow reputation or opinion. Sometimes you can bring in specific acts, right? If it's a civil case and characters at issue, or if it's rebutting a witness on cross, for truthfulness or something like that. But typically we're looking for reputation evidence when it comes to character evidence in Florida. This exception to hearsay is not recognized in Florida except on cross-examination of an expert witness.
Learned treatise.
Right, the learned treatise. There's no hearsay exception in Florida for learned treatise, but on cross-examination of an expert witness, you can use learned treatise to impeach them, but we're not going to read it into evidence. An opponent party admission is considered this in Florida.
Exemption?
It's an exemption, right? No, I'm sorry. No, it's not. In federal law, it's an exemption. In Florida, it's actually an
Exception.
exception. Yeah, Florida doesn't have exemptions. What's up, Zalpa? Long time no see.
Hey.
Welcome to the party. See, it's an exception. Florida has party opponent admissions are exceptions, where in federal they're exemptions. Just subtle difference, but it could be tested. The standard applied to Florida in expert testimony.
Daubert.
Right, the Albert standard. So the judge is the gatekeeper based on scientific, technical, peer review, publications, things like that. Okay, this is how an estate will be divided if there's no will in Florida.
Interstate.
Well, yeah,
Herpes.
both correct answers. Both. We'll accept both answers. It will be intestate, and Florida recognized per serpes distribution, which means that the distribution occurs on the first generational level, not per capita. So this allows a spouse to take 30% of the estate,
Elective share.
elective share, right? The probate estate and certain non-probate assets as well. Florida does not require that a spouse survive the other by this many hours. It's a weird way of asking this question.
Simultaneous death, right?
Yeah, this is the Uniform Simultaneous Death Act, which in most jurisdictions you have to have survived the other by 120 hours to have survived them. But Florida, even if you survive them by 7 seconds, you survive them and it'll be taken outside of the USDA. The name for a child who is born after the parent dies.
Preterm.
Right, pretermitted. The interest a child from a previous marriage will receive in a homestead when homestead owned by the father when the stepmother survives.
Remainder.
Yeah, typically the remainder. The wife will get the life estate, the kid will get the remainder, unless the wife chooses to split a fee simple with the kid. This has, all right, here we go. Business entities. This has limited liability and subject to double taxation.
LLC.
S
Corp.
corp or C
S
corp.
corp.
So you guys said LLC and S corp? Both those answers are wrong.
This
C corp.
corporation.
Yeah, C corp. Why is it not a LLC or an S corp?
I believe with an S corp you have limited liability and it changes the taxation where you're only taxed once, and LLC only the LLC is taxed, like you only file
Exactly.
tax.
Both LLCs and S corporations are subject to flow-through taxation, not double taxation. Double taxation we only see at the highest level, a C corporation, right? You gotta be making serious money to be a C corp, right? What does that mean, double taxation? It means that the corporation is taxed. Well, a lot of these corporations, they find ways not to pay taxes, but let's just say, on paper, if a corporation makes money, right, then they have to pay taxes based on their profit to the government, right? That's like super factual, right? If a corporation makes money, they have to pay as a corporation taxes on their profits, right? Then let's say you own stock in the company, right? And you get dividends, or you have capital appreciation, right? That's the easiest way to think about it. Let's say you own stock for 2 years in Google and then you sell it for $1 million profit. Are you going to capture $1 million profit?
No, you gotta pay taxes.
What type of taxes?
Capital
Uh,
gains.
Capital gains taxes, exactly.
I was gonna ask you, what if you reinvest it into it?
That's a good way to skirt taxes. Yeah, if you automatically reinvest, you don't have to. Taxes are not due until gains are realized. So as long as you don't realize the gains, you don't have to pay the taxes. I mean, that's what you should be doing, all of y'all. You want some simple investing advice? Just keep investing. Don't ever realize your gains, and then you won't have to pay the tax. I mean, eventually you will, but even then, we could figure out some ways to maybe transfer on death and avoid tax. I mean, that's the game right there. If you guys want to be important people in this universe, figure out taxes and wealth, and that's good advice. All right. So, what is a corporation, right? C corp. The partner who is personally liable.
General partner.
General partner, right? General partners are personally liable and actually manage the company. A way to hold the board of directors personally liable for actions of a corporation or the shareholders or a parent
Derivative
company.
lawsuit.
Piercing the corporate veil.
Yeah.
Piercing the corporate veil, yeah. Piercing the corporate veil, yeah. Derivative is not a horrible answer there, but what we're getting at is piercing the corporate veil. Just wondering, what are some reasons why you could pierce the corporate veil?
Ultra vires acts.
Commingling of funds.
Yeah.
Fiduciary duties, loyalty, usurping business opportunity.
So I think you're talking more about directors of or duties of a director and why you could hold them personally liable. What we're talking about is piercing the corporate veil and holding the owners liable, the shareholders, the parent company, board of directors too, if they're owners. But why would we pierce the corporate veil? For what reason? Someone said commingling of fund. That's pretty solid.
Using
see
the
if you check.
corporation to defraud.
Yeah, fraud, alter ego. I'm liking these things in the chat. I didn't even see you guys in the
Or
chat. Yeah.
illegal activity, maybe, right?
Right, illegal purpose, a fraud, alter ego doctrine, the deep rock doctrine, some reason that like it's just a shell for uh inadequate funding, right? Improper purpose. These are all reasons that we could pierce the corporate veil and go after the owners instead of the company. Okay. So acts by officers outside the scope of their authority. Natalia literally just said this word.
Ultravirus.
Yeah, ultra vires acts, right? They're outside their authority. When a person cannot deny the existence of a partnership.
Parent authority?
Actual authority, maybe?
It's a type of partnership.
General.
It's not, what'd you say?
General partnership? No?
No.
The partnerships that are assumed by behavior
Yeah,
when they don't need a corporation. You know.
right. So what is that? What's the legal term for that?
De facto.
Yeah, de facto.
No, de facto is improper filing, but an attempt. De jure is proper
Jure.
filing.
By estoppel.
Yeah, partnership by estoppel. Good job, Zalpa. Yeah, partnership by estoppel. You're stopped from denying the existence of the partnership because the third party, believed you were a partnership. You held yourselves out to be a partnership, so you're not going to be able to deny it. That's a partnership by estoppel. All right, Final Jeopardy, corporations. Let's see what we got here. It's very coincidental. Good faith but improper filing of the AOC, Articles of Corporation.
That's
You guys
de
just said this.
facto.
De facto.
That's a de facto corporation, yeah. All right, de facto company, whatever. Same stuff. All right, cool. That was fun. I feel like on a scale of 1 to 10, that was like a solid 5.5. All right, let's go over to PowerPoint. I'm gonna do the best that I can. Oh wow, there's 2 PowerPoints that I could do. One's done by Katya. Okay, let's do it. I'll start with mine. Usually I start with theirs, but I just know hers is gonna be a lot. So I'll start with mine to warm us up a little bit. Okay, you guys strap in. There's going to be a lot to learn today. All right, so Florida C corporations, like I said, business expenses are tax deductible because C corporations are already subject to double taxation. So they enjoy other tax advantages such as being able to deduct business expenses, and other types of corporations and businesses may not be able to deduct, right? A C corporation allows for significant growth potential because stock associated with C corporations can be sold freely with unlimited potential growth for these types of corporations. They can have multiple stock types. What are some examples of stock types?
Preferred?
Yeah, preferred shares versus common shares, etc. Right? Unlimited amount of shareholders, whereas an S corporation only allows for one class of stock and a cap of 100 shareholders. C corporations protect from various liability issues because C corps provide very limited liability for directors, shareholders, employees, and officers. C corporation is subject to double taxation, the largest drawback, and no deduction of corporate losses is another disadvantage in that shareholders are not able to deduct corporate losses on their taxes, whereas S corporation shareholders can deduct such losses. Main takeaway from this is that C corporations are subject to double taxation and limited liability. What does that mean, limited liability? It means that if you own shares in a company and the company goes to zero, how much do you lose? You own $1
Nothing.
million in Apple and Apple goes to zero. How much do you lose? If I invested $1 million in Apple and Apple went bankrupt, how much money would I lose? I invested $1 million and they went bankrupt. It's
Million.
not a trick question. Yeah, $1 million, right? You invested $1 million, you're going to lose $1 million. You're not going to lose $2 million though, right? That's what it means by limited liability. Your losses are limited to the amount you invested, no more than that. Shit, if you own a partnership, right? And you and Tommy are general partners in your lemonade stand, and then Susie drinks your lemonade and she, goes in a coma, and then her kid sees it, and then her kid suffers a heart. Like your losses could be, they're going after everything. Maybe not your home because it's Florida homestead, but everything else, right? You're gonna not just your investment in the lemonade stand, your liability is much greater than that. So that's what limited liability means, is that you can't be liable for any losses beyond your investment. So corporate formation, anyone could be an incorporator, be it a person or an entity. So right in the world of business entities, a person doesn't mean an individual. A person can also be an entity. Now, can an entity be a director on the board of directors?
No,
No,
because
actually,
it's
said
not
no. That has to be an individual. That has to be a human, right? But an incorporator could be Nike. Nike can incorporate SpaceX. I mean, don't think of that too much, but like potentially they could. So the articles of incorporation, the articles must state the corporation name, the number of shares and distinguishing characteristics of each class, the address of the initial registered officers, the names of the initial agent and acceptance of the agent, the name of the incorporator, the address of the principal office. They must include that. That could definitely be tested, like what must be included versus what may be included. The number of directors, the par value of stock, imposition of personal liability on shareholders to a specific extent, initial purposes, and any other provision. So the incorporators deliver the articles to the Department of State, and they have an organizational meeting. After incorporation, the incorporators will hold an organizational meeting to complete the organization of the corp by appointing officers, adopting bylaws, etc. 2 days notice must be given to each director about the organizational meeting. And the bylaws may contain any provision for managing the business and regulating the affairs of the corporation. So the articles of incorporation are what you file with the state. The bylaws are like kind of like your internal operating agreement, if you will. If there's a conflict between the articles of incorporation and the bylaws, what will prevail?
Articles.
Articles of incorporation, exactly. All right, so types of imperfect formation. So with de jure company, right? Think of like soup de jour, I guess, like the soup of the day, right? It was done properly. I don't know why that would help, but maybe has obtained a certificate of incorporation from the state. The de jure corporation definition is a corporation that has fully complied with the entirety of the state's incorporation requirements, meaning the company is a bona fide corporation under state law. You did it right. You did it de jurely. De facto was the last answer to Jeopardy question, have some legal protections, but not the full scope afforded to de jure corporations. For de facto corporation definition, a state recognizes a de facto corporation when its incorporators made a good faith attempt to comply with the state's incorporation statute, meaning they miss only technicalities. So maybe they filed articles of incorporation, but they didn't name the addresses of principal office. Okay, so you weren't a de jure company, but you still have some legal protections as a de facto corporation. And then corporation by estoppel, we talked about partnership by estoppel and playing Jeopardy, refers to someone contracting and dealing with a business as if it were a corporation. In doing so, it's an admission that the entity is a corporation and therefore a stop to deny its incorporation should an action arise out of the contract or course of dealing. So you guys know that word estoppel, right? Where else do we see estoppel? We see promissory estoppel. We could see deed by estoppel. We can see like the termination of an easement by estoppel, right? Estoppel comes up a lot. It just means that you are denied from recognizing an obligation. So S corps is tax similar to an LLC. So I have two companies right now. They're both LLCs. I should probably turn them into S corps. Probably just because based on the size of them and some of the tax advantages that S corporations have in terms of, how you pay employees and the fact that I could issue shares, S corporation is probably, according to like some smart people, more advantageous for me than a C corp. But it doesn't really matter in practice. I mean, again, like some tax, like financially maybe, but like from a broader perspective, they're pretty much the same things, what they accomplish, an LLC and an S corp. Think about it. An S corp starts as a C corp, so it's subject to double taxation and limited liability. It starts as a C corp. Then they elect under subchapter S to have flow through taxation. So now we have limited liability because we're a corporation, and we have elected flow through taxation. That's a nice happy medium. That's what you want. Pay taxes once and have limited liability. Now, what is an LLC? So I have two LLCs. My one is single member, the other is a double member LLC. But those LLCs start as either a sole proprietorship, IBIS Prep, or a partnership, IBIS Repair Group, and we have elected limited liability, right? Because we started off with flow through taxation as a sole proprietorship or as a partnership, but unlimited liability, and we have elected to file as this distinct entity that has limited liability. So they actually end up the same place, right? S corps and LLCs have balloons and confetti. They have limited liability and flow through taxation, right? That's balloons and confetti right there. That's what you want as a business owner. Typically, that's the best thing to create is something that has limited liability and flow through taxation. Can anyone think of any other types of business entities that have limited liability and flow through taxation?
LLPs?
Yes, an LLP, a limited liability partnership, right? It's like everyone in the partnership is a limited partner. See, same thing. They start off by having flow through taxation as a partnership, and then they have created this entity that has limited liability for all partners. Perfect. Any other examples?
What
That's a
about
good one.
limited partnership?
A what?
Limited partnership, LP.
For the limited partner, yes, the limited partner has limited liability and flow through taxation. The general partner has unlimited liability and flow through taxation. So that entity in itself, not for all people in it, but yeah, for the limited partners, yes, I agree. What else? Any other ones? Do any of you guys work at a law firm?
PCPA, something like that.
Right, PCs, PAs, these types of professional corporations and professional companies, chartered, associations, whatever they are, they will have like PLLC, right? I guarantee whatever your law firm is, whatever letters they have at the end of it accomplishes that limited liability and flow through taxation, right? It's just those are for professionals. So an S corp is taxed similar to LLC. An S corp does not pay any tax in 7 certain states and thus avoids a double taxation of a standard corporation. Unlike an LLC, however, which pays tax on the entire net income of the business, an S corp is taxed only upon the wages of shareholders who are also employees. Any additional income above and beyond wages is allocated to member shareholders distribution. Distributions are taxed at a much lower rate than employment taxes. That's why I was saying why it would be advantageous for me to change my companies from LLCs to S corps, because I have a lot of, well, don't tell the IRS, but I have a lot of people who work for me. You call them what you want to call them. I call them independent contractors. So an S corp must meet the IRS formal administrative standards, which include regular director and shareholder meetings, complete with records, adopted bylaws, financial records maintenance, etc. For LLC owners considering an S corp, I don't know what that means. Salaries and distributions in order to avoid costly audits by the IRS. I don't know what that even means, but just know that S corps are similar to LLCs. They just have tax advantages for employees. Whereas LLCs combines the liability protection of a corporation with a tax stream and ease of administration of a partnership. For when LLC offers pass-through taxation, flow-through taxation, same thing, where the members' owners report their share of the LLC's profit or loss on their individual tax returns. Any tax due is then paid at the individual level. So there's member managed LLCs and manager managed LLCs. Let's just assume, this actually isn't true, but let's just assume that IBIS Repair LLC is managed by me and Justin, right? We're the two members. That's a member managed LLC. That's the assumption. Let's assume that IBIS Prep is managed by Alexis, James, Bianca, and Danny, right? Those would be the 4 managers who manage on my behalf as the sole member. So in this hypothetical world we're living in, quasi-hypothetical, IBIS Prep is a manager managed LLC because those 4 manage it on behalf of me, the member, and IBIS Repair is a member managed LLC because me and Justin are the members and we manage it. So that's the distinction. Again, what did I just say? If it's no election is made, is it going to be member managed or manager managed? What's the assumption?
Member.
Member managed, exactly. Okay, so member managed, the owners are responsible for the LLC's day-to-day operations. Manager managed, members appoint or hire a manager, managers to run their business. Alexis, James, Bianca, Danny, they would be the managers of my manager managed LLC. Whoever manages the LLC will be able to open and close bank accounts, hire and fire employees, enter contracts, and take out loans. So LLCs, corporations, or partnerships, I mean, just a thought. It's a hybrid. It's a disregarded entity. It doesn't really exist anywhere except for in the eyes of the IRS. An LLC is an entity created by state statute. Depending on elections made by the LLC and the number of members, the IRS will treat an LLC either as a corporation, partnership, or as part of the owner's tax return, a disregarded entity. A domestic LLC with at least 2 members is classified as a partnership for federal income tax purposes unless it files Form 8832 and elects to be treated as a corporation. For income tax purposes, an LLC with only 1 member is treated as an entity disregarded as separate from its owner unless it files Form 8832 and elects to be treated as a corporation. However, for purposes of employment tax and certain excise taxes, an LLC with only 1 member is still considered a separate entity. I mean, this is not like going to be the answer to a question. I'm just kind of giving you some background information about LLCs and what they really are. They're creatures of the law, right? They're elections that are made to accomplish this goal of limited liability and flow through taxation. So we talked about this in the Jeopardy game, piercing the corporate veil. They're obsessed with testing this concept. A court may disregard the corporate entity or pierce the corporate veil in certain situations. Shareholders active in the business may be held jointly and severally liable as if they were partners, but inactive shareholders are generally not liable. Motives for a court to disregard. So we're going after the actual owners of the company. You know, if any of you went to University of Miami Law School and had Professor Alfieri for Civ Pro, I had him. Tough way to start your law school career, but he was signed a book, the Buffalo Creek disaster. This was all about piercing the corporate veil. It was all about subject matter jurisdiction, but it was about piercing the corporate veil where, like, you know, a parent company owned a subsidiary. That point, yeah, Victoria, you know, yeah, that class. He's actually a cool dude. Professor Alfieri is a cool dude. I played soccer with him. He's a cool dude. He's just a tough professor. But anywho, that book is about piercing the corporate veil, holding the parent company liable for the acts of its subsidiary, because it was determined that the subsidiary was just a shell company. It was only created to prevent or to absolve the parent company of any liability, to protect them from liability. So the alter ego doctrine, this is the main way they pierce the corporate veil. The court may disregard the corporate entity when the corporation appears to be the alter ego of the shareholders and used by them as a conduit for their personal affairs. Florida law requires a showing of improper conduct. Thin capitalization. A corporation must have adequate capital to meet its reasonably foreseeable needs. The rock doctrine. In bankruptcy proceedings, capital contributions that are denominated as loans by shareholders of close corporations may be subordinated to debt to outsiders. So that's what the deep rock doctrine means, is that, you know, if there's a bankruptcy proceeding, they could pay off outside lenders before loans by shareholders, because we're piercing the corporate veil and we're, you know, not allowing the insiders to get away with something. And then subsidiary corporations, a parent corporation may be liable for the debt of a subsidiary when the subsidiary is inadequately capitalized, intermingled with a parent, or otherwise not a true distinct entity. So really try to, you know, these words like alter ego, undercapitalization, parent subsidiary, piercing the corporate veil, try to associate them. I like that, Eric. Yeah, rock bottom, bankruptcy is a good way to remember. Hey, at this point, anything that'll help you remember is solid. And Victoria and Shakira, you were supposed to read that book in law school. I gather that nobody reads anything in law school anymore. They just ask AI to summarize it for them. It is what it is, right? I wouldn't want them to be my lawyers, to be honest, but you guys just get your money and stay humble. All right, so equity securities. So there's equity and debt. Good thing we're doing, guys. I know it's going to be a long class today, but good thing we're doing 2 PowerPoints, because my PowerPoint is kind of more focused on general overview and understanding, and then Katya, I'm sure we're going to go over some of the nitty gritty details in her PowerPoint. You know, I teach for the Series 7 and 66, the financial licensing exams, to become a stockbroker or a stock trader. I have my licenses, so I have an understanding of this from a broader perspective, and I try and teach some of that because, you know, a lot of these questions you can just get right if you understand the way that business works. So I'm going to try and explain some of these things. And even if you're like, oh, I don't know that particular question, like, it's not for that reason. I'm actually trying to teach you guys something today, make you more educated, and then going over Katya's PowerPoint, we'll go over more specifics that may be directly tested. But anywho, what's the difference between a stock and a bond? Which one is an equity security? Which one's a debt security? Obviously, the stock is the equity security and the bond is the debt security. What does that mean? It means that A stock is ownership stake in the company. So if you actually own the company, then you have stock in the company. Whereas a bond is just a loan to the company for the sake of being paid back interest. So there's two ways to make income from investing in corporations. One of them is obvious, right? A bond. If you own a bond, then you are going to get interest on your principal. You lend the company, right? Let's say IBIS Corporation issues bonds. You guys pay me, par value, $1,000 per each bond, and I'm going to pay you 8%. So typically they pay it semi-annually. So every year, you'll get $40 every 6 months. You'll get $80 a year for 10 years. And then at the end of it, typically, I'll give you your $1,000 back. So you'll have made that income, that $80 a year for 10 years straight. You'll have made $800 of income, right? That's one way to make income off of an investment security. What's another way to make income, specifically off a stock? How can you receive income from a stock? Not
Dividends.
capital. Yes, dividends, exactly. Dividends are how you receive income from a stock. Which class of stock has dividend priority if they're declared? It's on this PowerPoint slide right here.
Preferred.
Preferred. That's what preferred means. It means that they have dividend priority and liquidation priority. In the event that the company goes bankrupt, preferred stockholders are going to get paid back first. So people out there are like, oh shit, preferred stock is way better than common stock. That's probably what you think, right? Now, if any of you invest in the stock market, none of you guys are going to buy preferred stock. You would all buy common stock, right? It doesn't make sense unless you understand it a little bit more. Everything in finance is a cost benefit analysis. So if you are getting dividends, you are necessarily stunting your potential for capital appreciation, or you're paying more for the instrument or something like that, right? There's some reason that you're getting dividend priority and you're getting liquidation priority. Is because the common stock has more room to grow, or the common stock costs cheaper per share, something like that. But anyway, that's the difference between common stock and preferred stock, is that preferred stock has dividend and liquidation priority, and then common stock, they get voting rights. They get a lot of these rights: voting power, ownership of the company, right to transfer ownership, right to dividends, right to inspect corporate books and records, and the right to sue, derivative suits or direct suits. Stino's asking a good question. Are either non-dilutable? They both come with anti-dilution rights. Anti-dilution rights mean that you have the ability to purchase your proportionate share of the company if the company were to authorize more stock. So there's different types of stock when a company is created. There's authorized stock, there's issue stock, there's treasury stock, and there's outstanding stock. Authorized is what they're allowed, how many shares they're allowed to issue in the corporate charter, right? Issued is how many they actually sell to the public. Treasury stock is if they buy back, so they reprivatize. There's stock that's out there that's issued, and then they buy it back. So authorized, how much they're allowed to sell; issued, how much they actually sell; treasury, whatever they bought back; and then necessarily outstanding would be issued minus treasury, whatever's still in the hands of the public and hasn't been bought back. Anywho, if you're going to authorize more shares, right? So like right now, there's 1 million shares, and I have let's make it easier. There's 100 shares and I have 10 of them, right? I have 10% of the company. Well, now they're going to authorize and issue 100 more shares. Well, shit, now if I only have 10 shares and there's 200 shares out there, I'm going to have 5% of the company. So what do I have? I have anti-dilution rights, where I can buy my proportionate share to maintain my stake in the company. So if they issue 100 more and I had 10, well, I can buy another 10 before anyone else. So now I'll have 20 shares out of the 200, which maintains my percentage from the 10 out of the 100. So that's a good point too. All stockholders have what are known as anti-dilution rights. And then preferred stock is stock with priority access to dividends. Whether preferred stock is cumulative or straight, non-cumulative, determines the issuer must make up skip payments. If it's cumulative, the issuer must pay mixed dividends to preferred shareholders at some point. If it's straight, the issuer will not make up the skip dividends. All right, this is going to annoy y'all too. There's two instances where they use the word cumulative when it comes to stocks, right? There is cumulative preferred stock, and then there is cumulative voting rights, right? So cumulative preferred stock is this situation right here where let's say dividends are 4%, right? So if dividends are declared, and again, dividends are not like mandated. It's only if the company makes money and they have extra money to pay out dividends. Okay, so if dividends are stated at 4% and we pay preferred 4% year one, year two we don't pay dividends. Now year three we have 8% to pay out. Well, it depends if it's straight or if it's cumulative. If it's cumulative, you would have to pay all 8 of that to the preferred because you missed a payment in arrears. So you'd have to pay them their 4% for last year, and now you'd have to pay them their 4% for this year. So they're going to get all 8%. If it's straight and there was a missed payment, we don't even look back. We just say, okay, there's 8%, 4 goes to preferred, that's what's stated, and the 4 that's left over is going to go to common. So that's what cumulative preferred stock means. It means that it allows you to get paid back for missed dividend payments in arrears. I don't know how heavily tested that one is. What's more heavily tested is cumulative voting, right? Cumulative voting is for common stockholders who have the right to vote for the board of directors. And cumulative voting, like let's say there's 2 people there's 2 spots open on the board, right? And I have 10 shares. I get 10 votes. So under straight voting, I have to put 5 for chair A and 5 for chair B, right? That's straight voting. Under cumulative voting, I could stack all 10 of my votes for chair A, right? That's what cumulative voting allows you to do. It allows you to stack your votes for one chair. Cumulative voting benefits the smaller investor. Why? Because now I have we can get A on the board. You know what I mean? I can use all my votes to get A on the board instead of all my votes just being diluted across the open chairs, right? So cumulative voting allows you to stack your votes for one chair and it benefits a smaller investor. Cumulative preferred stock allows preferred stockholders to be paid back for missed payments in arrears before common stockholders are paid out their dividends. Big differences between common stock and preferred stock. Common stock has voting rights. Preferred stock has dividend priority and liquidation priority. If a company, I'll get to this, I think, but if a company goes bankrupt, they liquidate, there's an order of operations of who gets paid back. First is going to be taxes and employees, right? Uncle Sam and the people who worked. Then you're going to pay off creditors, debtors, secured debt, unsecured debt. And then finally, we're going to pay off the equity owners and we're going to pay off preferred shareholders first. If there's any money left over, that will go to common stockholders, right? They have the most risk in that sense, but clearly the most reward in terms of like, if you guys just didn't go to law school and took all that money and invested in a company like NVIDIA or something, you'd be doing a lot better than you are for now. Maybe the law degree will take you to the moon, but capital appreciation and investing is how most people make their money in this world, by ownership of common stock. All right, so debt securities, a bond is a debt obligation, like an IOU. We're going to do some debt instruments on Wednesday. Does anyone know what debt instruments we're going to do on Wednesday?
Securities and Article 3, right?
Commercial
Secured
paper.
transactions.
Article 3, yes. We're going to not secure transactions. Secure transactions I wouldn't call necessarily debt securities. That's more of a
So commercial
more of an
paper, you mean, right? Article 3.
commercial paper is what I mean. Commercial paper, money market instruments, promissory notes, literally cashier's checks, right? These short-term debt instruments that comprise the money market, those are debt securities because that's literally what they are. They're obligations to pay someone back money. They're loans that typically have a principal and an interest. So securities, what does that word even mean? Securities, because you hear secured transactions and securities, well, kind of weird. Securities are tradable financial assets like stocks and bonds and some of these other things, debentures and other instruments like mutual funds and ETFs, that's a consolidated basket of stocks and bonds, whatever it may be, those that are tradable financial assets. That's what a security is. Secured transactions means like collateral, right? Like there's a loan that's backed by collateral, so it's secured, right? It's kind of like almost like a mortgage where the home is the collateral for the loan. In secured transactions, it would be the consumer good or the inventory or the equipment or the farm product that would be collateral. But that's on Wednesday. Right now, we're talking about securities, meaning tradable financial assets. Typically, securities are stocks and bonds. Equity securities are typically like stocks, and debt securities are typically bonds. So a debenture is a type of bond or other debt that is unsecured by collateral. So a debenture, it's pretty much a junk bond, right? It's something that's a very high risk, potentially very high reward. A registered bond is a debt instrument whose bondholder's information is kept on record with the issuing party. And then a bearer bond is a fixed income security that's owned by the holder or bearer rather than by a registered owner. Okay, I just mentioned this, the order of liquidation of corporate assets. And when I took the Florida bar in February 2017, I remember they asked this exact question. Like, what's the order of liquidation? You had to, choose it. So if a company is forced to liquidate its assets, it will pay liquidation funds in this order. Wages and taxes first, then secured creditors and unsecured creditors, then junior unsecured creditors, then preferred stockholders, and then at the way bottom of the list, common stockholders have junior liquidation priority. Promoters, they love to test this concept, a promoter. A promoter is someone who undertakes to form a corporation and procure the necessary capital and other items. They're the person running around the street saying, hey, I'm starting this company. Do you guys, want to pitch in, right? I just had a friend in town, him and his friend, they're like serial entrepreneurs. The one kid started this dating app. It's called Locks. And he's dated like Camila Cabella, and now he dates Emma Watson or something. I used to play baseball with this kid, but yeah, serial entrepreneurs, and they got a lot of promoters to, invest in their company. Good for them. I wish I was better at that. So a promoter undertakes to form a corporation to procure the necessary capital and other items. Promoters must act in good faith in the best interest of all investors. A promoter who profits from a sale to a corporation may be liable to it for profits. Promoters remain liable on contracts they enter on behalf of the corporation, even after the corporation adopts the contract, unless the parties agree to novation. They love testing this. Every bar exam, whether it's a UBE, whether it's Florida, I've seen this tested a lot in the bar world. I don't know why. It's like piercing the corporate veil. They're obsessed with randomly weird things. This is one of them, that a promoter can remain liable on a contract even after the corporation is formed, unless there's a novation, which is an express agreement to substitute the promoter for the corporation. So the bar examiners often test on promoter liability. Remember that generally promoter will be personally liable on a pre-incorporation contract unless the contract clearly negates personal liability, in which will be treating as a continuing officer of the corporation. Even after the corporation is formed and adopts the pre-incorporation contract, the promoter remains personally liable unless there's a novation, which is a specific agreement by all parties that the promoter will be released and the corporation substituted for the promoter. All right, so there's such things as derivative suits and direct suits, right? A derivative suit is one brought by the shareholder to enforce a corporate cause of action when the board of directors, for some reason, has not sought to enforce the corporation's rights. So you're kind of suing on behalf of the shareholders. The shareholder must first make a demand on the directors and then prosecute the suit. The shareholder must wait 90 days before bringing suit unless the shareholder is notified sooner that her demand has been rejected or the delay will cause irreparable injury. If the corporation commences to an investigation of the charges, the court may stay any proceeding for such period as the court deems appropriate. To be eligible to bring suit, they like to test this. The shareholder must have owned stock in the corporation at the time the action commences and when the alleged wrong took place. So you can't be if you sold your stock, you can't bring a derivative suit anymore. If you bought stock after, the bad thing happened, you don't have standing, right? So you have to have owned stock when the wrongdoing occurred, and you have to still own stock in order to bring the derivative suit. On a motion by the corporation, the court may dismiss a derivative proceeding if the court finds that one of the following groups made a good faith determination after concluding a reasonable investigation that maintenance of the derivative suit is not in the best interest of the corporation. So it could be a majority vote of qualified directors if qualified directors constitute a quorum. Qualified directors typically mean disinterested directors, right? If you're interested, you're not qualified. Interested means like, okay, what if okay, IBIS Prep, we have an office, a couple blocks away. What if me and Alexis and James are all, we are all board of directors, whatever. And then I say, oh, we need to fix, some leak in the wall, in the ceiling. Well, I'm like, hey, let's get IBIS Repair Group, right? They're the best in town. I'm fucking interested and I would not be qualified, right? That's what that means when you're qualified. You're not interested in it. Me, and then if James and Alexis, they read the Google reviews and were like, yeah, IBIS Repair Group is the shit. they could vote to bring it in, but I would not be able to partake in that vote because I wouldn't be qualified because of my interest in the transaction. What about this word? Does anyone know what a quorum is?
It's like to vote in a corporation, right? You can have like proxy vote, or you need like special meeting, regular meeting in bylaws.
That's fair enough. What else? Does anyone know what really a quorum means?
It's the majority of the people voting. Even if like so if they're absent and then the majority would be the majority of the actual number. So if there's like uh 20 members, but then like some people have left and you need a quorum, it's like the majority of the people still counting 20 as the under number. So it would be the majority out of 20.
Right, exactly. It's typically the number of shareholders you need to hold a vote, and then once you have a quorum, you could have a majority vote. So majority vote of a committee consisting of 2 or more qualified directors appointed by majority vote of the qualified directors, regardless of the quorum, right? That's a way we could, still uh determine that a derivative suit is not in the best interest. And then a panel of one or more disinterested independent individual persons appointed by the court upon motion of a corporation. So these are people who can come in and be like, all right, we're still not bringing the derivative action. It's not in our best interest because we either had a majority vote of qualified directors, we had a majority vote of the quorum, or we had a panel of disinterested independent people who came in and had this vote. Okay, so another thing about common shareholders I didn't mention is they get to vote, and you guys just kind of assumed, or I kind of like just was speaking about what do they get to vote on? The board of directors, right? That's like the main thing that they vote on. And I like what Natalia said, they could vote by proxy, they could vote by shareholder agreement, subscription agreement. Like there's like different ways that you could vote, sure. But you typically think of voting as electing a director to the board, right? But there's other things that shareholders get to vote on. One of them, I mean, these are obviously the answers, right? Mergers and consolidations. Those are fundamental corporate changes. Does anyone know any other times where shareholders get to vote?
When they're directly affected by an action. So if it messes up with like their stock or something like that, even preferred shareholders would be able to vote like in that type of instance if they make it.
Okay. That's a good answer to not necessarily the exact question I asked, but I like what you're saying there. That yeah, preferred shareholders do not get to vote. Common shareholders get to vote. But preferred shareholders do get to vote if it's something that is going to impact their status as a shareholder. So if they're gonna bring on a new class of people who get voting rights or who get dividend rights ahead of preferred shareholders, well, that's directly impacting preferred shareholders. So in that case, preferred shareholders would have to have a majority vote as well as common shareholders because it's directly impacting them. I like that. That's when preferred shareholders get to vote. My question was, when else do common shareholders get to vote on what other issues besides mergers, consolidations, and electing directors to the board? See.
Maybe when they're trying to expand into the different branch of the business.
Well, it's going to be fundamental corporate changes. So maybe Natalia, if that's considered a fundamental corporate change because it's not, authorized in the articles of incorporation of the bylaws. But yeah, okay. So I like what Joanna, Tenny, and Eric are saying. Liquidation events. There's a classic question they ask on the FBB practice question where it's like, IBIS Corporation is going to sell all of its computers. Its computers are its only remaining assets. Can they do this? And it's like, well, yeah, if they're selling all of their remaining assets, they are it's a liquidation event, and that's a fundamental corporate change. Joanna's saying merger, we got that. Ben saying elect directors, we got that. Anything else? You guys want to ask Claude or who's your favorite AI guy? I would also say stock splits, right? If there's going to be you guys know what a stock split is? If it's like, Tesla they did a bunch of stock splits. Say shares of Tesla are going for $1,000. Well, what would they do? They would probably do a stock split where they'll give everyone they'll change the price from 1,000 to 500 and they'll give you all 2 shares. So you still have $1,000 worth of Tesla, but now you have it at $500 a share. So, Susie and Tommy can buy in and it looks different. Stock splits do not dilute, Victoria, because you actually maintain the proportion. All they do is just lower the price, or you could have a reverse stock split and raise the price, but all it does is change the listed price. It doesn't change your proportional ownership stake in the company because you're getting the same value, right? So if it's like I said, if the shares were going for $1,000 a share and you had one, they would change it to $500 a share, and you would get 2 for 1 for every share you have. You would get another one. So now you would have 2 shares, 500 a piece, instead of having 1 share, 1,000 a piece. But you would still own $1,000 worth of the company, and the company still has the same thing. And then Stino saying he thought he lost so much money the first time it happened with him. Yeah, I mean, it's interesting.
I had a heart attack. I was like, Netflix just freaking cut in half. I was like, what? I just, it was crazy.
Well, Netflix also cut in half on its own accord.
Yeah,
And
Netflix also sucks as an investment.
yeah, you need to get a stock split to lose all your money in Netflix this year. But when I was in business school, I was getting my MBA, and we all had to pick a stock, and we were in a group, and I was arguing with my group. Imagine me, the JD student in business school, arguing, and I was saying we should go with Netflix. And I had a really good theory about it. I'm sorry, I said we should go with Home Depot. I had a really good theory about it. I was like, listen, we're coming out of a recession. Usually when the economy comes back, building construction comes back, and who's beneath the building? Home Depot. Let's do it. So I was like dead set on Home Depot. My group was dead set on Netflix. And I was like, Netflix? Like, what? They're gonna get beat out by Redbox. Like, that's a stupid business. Who would ever buy a Netflix? I had not seen a vision of Netflix at all in 2013, but I'm not right about everything. So Netflix has taken off, but yeah, in the last year, they've taken a nosedive. So maybe my premonitions were just 13 years too early. But I think Netflix will recover. They just got to do more Adam Sandler movies, I think. All right. So anyway, those are some things that people can vote on, right? Fundamental corporate changes. Here's another one: amending the Articles of Incorporation, right? If you're going to go back and change the Articles of Incorporation to authorize more shares or to, XYZ, then that would require a shareholder vote. So amending the Articles of Incorporation, stock splits, mergers and acquisitions, electing the board of directors, and liquidation events are some of the most common things that shareholders get to vote on. And then Heather saying my dad thought the same about Amazon, was just a bookstore, and look at it now. Yeah, no, some of the best advice I ever got in my life is don't believe everything you think, right? The smartest guy I know is wrong a lot. You know what I mean? So like, you can't be someone who thinks you're always right. That's not the case. You gotta yeah, it's okay. Even if your dad was wrong, your dad could still be so rich off of Amazon as long as he changed his opinion at some point in the last 20 years. You're allowed to change your opinion on things. So that's some random advice. Okay, anywho, consolidations, when 2 or more corporations combine into a new corporation. That's a consolidation, right? A and B are going to create C. We're going to consolidate into C. Where a merger is usually where there's going to be one company is going to Pac-Man eat the smaller company and take over. I think you can think of a lot of examples when that happened. I don't know, Meta merged with, or Facebook merged with Instagram, and Facebook remained the company. I guess now it's Meta or something like that. So a statutory merger is when one corporation is acquired by another, the target company is absorbed. The plan must be adopted by the board of directors and approved by the shareholders of both corporations. A short form merger is when a parent company owns at least 80%, so no shareholder approval is necessary. A triangular merger is pretty much when you have 2 companies and then they form a new subsidiary and merge into the subsidiary. So acquiring corporation creates a subsidiary, which then merge with the target company. If the subsidiary survives, it's a forward merger, what I was just talking about. If the target survives, it's a reverse triangular merger. A de facto merger, when one company buys all the shares of another company, the surviving company is liable for all debts of the target company, and shareholders receive the rights of a statutory merger, meaning they can vote on it. And then a share exchange, when some or all of the shares of one corporation are exchanged for some or all the shares of another corporation. However, neither corporation ceases to exist. So just some random stuff that happens. But I think the big takeaway is mergers require shareholder approval. Shareholder means common stockholders, majority vote. Like Shakir was saying, preferred shareholders do get the chance to vote if it's something that's going to directly impact their status as a shareholder, but usually preferred shareholders don't get to vote. What do they get? Dividend priority and liquidation priority. So dissolution, a corporation may voluntarily liquidate and dissolve at any time without judicial supervision. Notice must be given to all known creditors. In Florida, the articles of dissolution are not filed until the liquidation has been completed, right? That's a voluntary liquidation dissolution. An involuntary dissolution, any shareholder can bring an action to have the corporation voluntarily liquidated and dissolved if there's a deadlock of the directors and the corporation is threatened with irreparable injury. So this happens a lot with closed corporations. Closed corporations are super small. Usually they're limited to 35 shareholders or whatever it may be. and they're like family-run organizations. They often have a deadlock because it'll be like two people on the board of directors. Like imagine Justin and I had a Ibis Repair Corporation and we were the only two directors. One simple argument and we would face a deadlock. The shareholders are deadlocked in voting power and able to elect successor directors. There's waste or misappropriation of corporate assets, or the directors or those involved in the control of the corporation are acting, will act, or have acted illegally or fraudulently. Then we can have an involuntary dissolution where a shareholder can force the company to dissolve.
Andrew, can you the non-filing of the annual report? Does that how does that make it a involuntary dissolution? But also, I think that you have the right to retake the corporation, so it's like pending. I don't know. I don't really understand that. Like, what happens
Yeah,
after?
I think I know what you're talking about, where you're saying that like the corporation fails to file its annual report, which it has to, right? So then that would lead to we can move for an involuntary dissolution. But you're saying that the shareholders now have the opportunity to pretty much continue the existence of the corporation, but they would have to it would be like a takeover where now we're going to have a whole new board of directors and people who are going to follow the procedures. I'm not sure if you got that from a specific question or if you have any follow-ups. I don't know too much about that, but I think I know what you're talking about. That like if you don't file the annual report, that could lead to an involuntary dissolution, but the shareholders can elect to continue the existence of the company, and there'll be some process for
Can take
reorganization.
back the company as well, just like paying the fee and stuff. But I was just more so wondering as to that second part, like if they what the shareholders could do in that regard. But okay, thank you.
Yeah, honestly, I don't know too much about that, but if you can find a question that you got that information from or where it is, you can share it with the channel, take a look at it. But I don't know too much about that, to be honest. All right, rules and regulations. Again, I remember seeing this word on my test, Sarbanes-Oxley. I remember seeing blue sky laws on my test, and of course, the insider trading. That's why I tell people this is the hardest subject on the bar exam because they test it like it's like like you guys went to business school. You know what I mean? It's very strange how detailed the corporation's part of the test is. Okay, so let me oh, it's not a question, you're just wondering. All right, so yeah, I'm not exactly sure, Shakir. You might stump me on that one, but I think what you're saying is true that it would be involuntary dissolution, and then the shareholders do have the rights to assert reorganization of the company to continue its existence. I just don't know the exact procedure. Okay, so rules and regulations of corporations. So does anyone know what happened in 1929?
Is that the stock market crash?
Right, yeah, it's the stock market crash, right? The Great Depression was set off. And what was the reason behind it? Well, there's a couple reasons. Number one, I would say, was that there was no Truth and Securities Act, there was no Paper Act, there was no Act of 1933, right? 1933 solved this problem, which was that, people were selling bullshit. People were like, hey, this is my corporation. I call it like Saratoga Springs Corporation, and we, invest in us. And people were like putting millions of dollars, and then they were just absconding with the money and going off to Italy, right? There was no regulation that if you were going to have an IPO, initial public offering, you had to first send out a prospectus to potential buyers to be like, yo, this is what this is what the company is about. These are the numbers of sales we did. These are so that's what the Act of 1933 is. It requires registration with the SEC and a prospectus to accompany any new offering, an IPO, an APO, an SPO, right? Initial public offering, alternate public offering, subsequent public offering. I might have actually butchered those terms, but pretty much public offering where we're issuing shares to the public, right? That's the Act of 1933. Just so you know, the Act of 1934 is what regulates the people. They call 33 the Paper Act and 34 the People Act. 34 regulates broker-dealers and things like that. So exemptions to registration. So that's what registration is. If you're going to sell securities in the open market, you need to register with the SEC. These are for interstate securities, right? Not intrastate securities, but like Apple, Google, SpaceX, these big ass companies that are selling on the New York Stock Exchange, on NASDAQ, or on pink sheets, penny stocks, but they're selling on the national market, right? They have to register, and register means filing with the SEC and sending out a prospectus. They call it a red herring, actually. So anywho, exemptions to registration, Reg D private placements, Reg A plus small offerings, government issues, municipal issues, religious and charitable offerings, Rule 506 to accredited investors, and Rule 504B for limited offerings. Meaning that there's, good ones to know. Charities, churches, municipalities, they don't have to register. What's an accredited investor? Accredited investor is someone who makes a lot of money. Typically, I think it's over $2 million net worth, or you make over $200,000 a year. So they changed it since I've been in the industry, but something like that makes you an accredited investor. That's how people are able to buy into IPOs before common people, because they're rich. If you didn't know this already, the world is designed to make the rich get richer and to keep the common folk down. But that's actually very factual in reality. And this is one way that occurs. Rich people get to be accredited investors. They get to buy into IPOs before the common person. Okay, Rule 10b-5 insider trading. This I remember being tested on my test. The tipper, the tippee, who could be held liable for insider trading. Think of Martha Stewart. This is why she served time, right? Elements of insider trading claim are misrepresentation or omission, improper conduct, proximate cause. An insider is anyone who learns of material non-public information or has a fiduciary duty to the company. Both tippers and tippees may be liable for insider trading. Now, if I'm, sitting there having lunch and Susie comes up to me and is like, yo, Andrew, I work for SpaceX. They're literally going to announce a new rocket next week and the stock is literally going to rocket. Don't tell anyone, secret. If I go out the next day and buy a shit ton of SpaceX stock, I'm going down, right? I'm a tippy. Now, if I say, oh, thank you for that information, and then I go back to eating lunch and working my, I don't know what I would call it. It's definitely not 9 to 5, but I work my job and I don't do anything on it, that wouldn't be insider trading. You have to act on it, right? Or you have to tell someone. Now, if I do nothing, but then I tell Tommy and then Tommy goes and buys stock, I'm liable too, because, I perpetuated the tipping, right? So think about the tipper tippy rule, Rule 10b-5 of insider trading. And usually everyone who looks like they should go down is going down. If you did something wrong, then you're going down. Rule 16b, this is for control stock. Any director, officer, 10% shareholder is liable for short-term profits to a company within 6 months. So a couple IPOs this summer, right? Initial public offerings. SpaceX, for sure. I don't know if you saw what happened. It listed at like 150. It went up to like 216, then went back down to like 140. I mean, it's a lot of, the stock market isn't real. You know what I mean? Don't just invest in and sit back for the ride, because it's not a real thing. But that's an IPO, right? I think there's going to be Anthropic IPO this year, and OpenAI, right? The AI train is coming, right? So you can invest in those stocks. Historically speaking, if you invest in IPOs, it works out in the long run, but not necessarily in the short run. What's a risk you take when investing in an IPO? A risk you take is that in 6 months, the stock is going to tank. Why is that? Because let's say SpaceX right now, all the directors, officers, or control persons who own 10% shares, they have hella SpaceX, right? And they want to cash out so they can go buy, Goyard bags, right? They want to take a trip to Greece, but they can't sell for 6 months after the IPO because that's Rule 16b, right? Rule 16b prevents basically, a pump and dump. It prevents, from selling and cashing out on everyone and laughing at them, allegedly. So that's what Rule 16b is that for 6 months, these directors, officers, 10% shareholders, these control people cannot sell their stocks, or they're going to have to pay the profits back to the company. Exactly what Eric's saying. It's a lockup period for 6 months where they can't make a profit on their shares. But what's the risk? The risk is 6 months from the IPO, they're going to cash out, and then the stock is going to plummet. Again, like I say, stock trading isn't a real thing. Don't listen to what you know or what you think you know or what they think they know. Just invest in good companies and wait it out for 10 years. That's the best advice I can give you. All right, these two things were tested on my exam, Sarbanes-Oxley and Blue Sky Laws. And I remember when I took my exam, I was like, good thing I went to business school, because I don't know how people were going to learn this stuff who are lawyers, right? It's a tough part of the exam. Sarbanes-Oxley and Dodd-Frank were, these were names of legislators who created legislation in response to like Enron and WorldCom Do those names ring any bells to anyone out there? Enron, WorldCom, yeah, these were super scams, right? They were these companies that basically were just lying through their teeth and having these huge valuations, but they were like didn't even have enough money to buy a pack of bubble gum. So a lot of people went to jail. A lot of people lost a lot of money and jumped off of buildings and ended their lives over this. So basically, in response, they created the Dodd-Frank Act and the Sarbanes-Oxley Act, and they're mostly about auditing and some compliance, that now all these corporations have to have internal compliance and auditing measures to make sure that like it's not some bullshit and people are going to get super fucked, right? So Sarbanes-Oxley requires executives and financial officers to certify that they've reviewed the corporation's financial reports, that the reports are accurate, and they've listed any fraud, deficiencies, or major changes. That's Sarbanes-Oxley, and then Dodd-Frank is about internal auditing measures. And then blue sky laws also tested on my exam. If you see the word blue sky laws, just pick the answer that's related to intrastate securities, not interstate, but intrastate, meaning only sold within the state of Florida. That's not subject to the Act of 1933 because, like I said, it's not an interstate offering. It's an intrastate offering that's subject to the blue sky laws, which are state regulations that are created to help protect investors against possible securities fraud. Any type of security being sold or offered within a state must register or have to qualify for an exemption, right? So blue sky laws are pretty much the intrastate version of the Paper Act. Tough little slide. All right, some definitions. This is cool. Ultra Vires Act. This was a Jeopardy answer. An act that's beyond the powers conferred upon a corporation by its articles of incorporation or by the laws of the state of incorporation. So the director did something that was beyond his authorization. Watered shares. Shares of a company that are issued at much greater value than its underlying assets, usually as part of a scheme to defraud investors, right? The shares are watered down in the sense that like they are listed for 800, but they really should only be valued at 40. And it's to get, idiots like me to think that the company is worth more and then invest, and then they're gonna dump on our heads, right? The Florida Business Judgment Rule. This is tested a lot in bar exams, MEE, Florida, Next Gen Bar. I don't know if y'all know this, but business entities is actually a multiple choice subject on the Next Gen Bar. It's the typical MBE subjects. They've added business entities, and in 2028, they're adding family law. But just something to know if you're considering taking the Next Gen Bar. So the Florida Business Judgment Rule protects the business decisions of a director or officer as long as the director or officer acts in a reasonable manner. So it's a lot like that question about, oh, there's a trustee of a trust and, the account goes down. Did he breach a duty? And it's like, no, just because the account went down doesn't mean he violated a duty, right? The stock market could have gone down. Same thing with the business judgment rule. You have to assume that people in this position, directors of businesses, have to face tough decisions. And a lot of times in business, you're stuck between a bad decision and a worse decision, right? A rock and a hard place. Either we lose 1 million or we lose 10 million. I picked the choice to lose 1 million. So now everyone from the outside is like, oh, you breached the business, you breached your duty of care and loyalty because you lost us $1 million. It's like, no, you have to assume that under the business judgment rule, I acted prudently. I did the best that I could. It's just stupid business, right? And then the corporate opportunity doctrine, the legal principle providing that directors, officers, and controlling shareholders of a corporation must not take for themselves any business opportunity that could benefit the corporation. So if someone comes to, hey, people try to do this to my business all the time, right? Nobody cares about small business owners in America or in the world. But like, what if someone comes to, let's just say Katya is a director of my business, right? And someone comes to Katya and is like, hey, Katya, you're such a good tutor. I need help with the bar exam. And Katya's like, all right, I'll tutor you on the side. Don't tell IBIS, right? That would be a corporate opportunity. They have to come to IBIS prep and be like, hey, I have a student. Do you guys want to take on the student? And if we say no, we don't teach for the Georgia bar exam. Go ahead, take it on your own. That's okay, right? If the director is given permission by the company or the inaction by the company had opportunity and just, they just didn't pursue it, then, they could pursue that opportunity. But you do have a fiduciary duty as a director, officer, or control shareholder to present these business opportunities to the board, to the company. Go ahead. Shahir?
Sorry, is reasonable time for the inaction like a month, or like how long is it considered to be an inaction?
Yeah, I mean I don't think there's a bright line rule, but I do think like it depends on what it is. It means like that they had a reasonable opportunity to pursue it and they chose not to. So it depends, right? Like if it's like, buying a crop of strawberries in strawberry season, and strawberry season only lasts for 3 months, or 3 weeks, then then it could be 2.5 weeks because now like so it's not a bright line rule, but it's just a reasonable time. You'll be able to see that answer if it is the right answer, or it'd be like, what's the best argument? And it would be like the inaction of the company allowed Susie to pursue the opportunity. So thank you for the corporations, business entities. Yeah, I didn't really go over partnerships in that PowerPoint, but don't worry. I'm gonna do Katya's PowerPoint, and if you thought mine was boring, hers are typically even more dense. So let's just stay locked in because it says a very important, difficult subject, and you got nothing better to do right now than listen to this. There's not even any soccer games on tonight, I don't think. All right, so overview business entities by Ekaterina Katya Cross, Esquire. So this presentation offers a comprehensive but focused breakdown of the most commonly tested rules regarding business organizations for the bar exam. We cover the fundamental legal frameworks, formation requirements, management structures, and liability issues for partnerships, limited partnerships, corporations, and LLCs. A lot of cute pictures too. So partnership requirements. A person can be an individual legal entity. The intent, at least, so this is partnerships. We just talked about corporations. Now we're talking about partnerships. So at least two persons intending to co-own for profit business. No specific intent to form a partnership necessary, commonly tested. And there's no writing agreement. There's no filing. If Tommy and Johnny are like, yo, let's sell some lemonade and make some money, it's hot outside, that is a partnership. It's assumed to be a general partnership. The agreement can be applied by conduct, even if no written or agreement. And under the statute of frauds, a written contract is not required for formation, right? Extensive activity required beyond passive co-ownership. And it has to be for profit, right? And the assumption is if it's not specified others, they're going to split profits and losses evenly in a partnership. So the profit sharing test, equal profit sharing is a presumption of a partnership. Exceptions are debt payments, interest loans, rent, wages, goodwill, retirement, and health benefits. Okay, so the nature of a partnership is a separate legal entity. There's no protections. General partners are personally liable for the partnership's obligations, but partnerships get passed through taxation, and a partner can commit the partnership to contract. This is tested all the time, where it's like, Susie is a silent partner and has nothing to do with anything, and then she goes to the hardware store and buys a bunch of hammers. Is the partnership liable for those hammers? The answer is yes, because she had the authority. They subtly test these concepts of like actual authority, apparent authority, inherent authority, where an agent can act on behalf of a principal and bind them. And like usually if you're in doubt, the answer is yes, they can bind the partnership to the contract because of some authority or apparent authority theory. So fiduciary duties, always loyalty and care, the main ones for like all fiduciary duties. That's like, you can always mention loyalty and care. So loyalty is the duty not to compete, adverse interests, or usurping opportunities. The exception, the partnership can designate some activities as not violating the partnership agreement, can designate some activities as not violating and provide safe harbor, but cannot eliminate. You can't eliminate the duty of loyalty. You can provide some provisions, but not totally eliminate the duty of loyalty. So partnership agreements, they're not required, but they're encouraged. You know what I mean? As a good lawyer out there, if you have friends with the partnership, they should have a partnership agreement. Justin and I definitely have, we have what's called an operating agreement because we're LLC. The duty of care. So no gross negligence, recklessness, intentional misconduct, or knowing legal violations. And the partnership agreement cannot unreasonably reduce this duty. And good faith, you must act honestly. The partnership agreement cannot eliminate, but can give standards. So duties of loyalty, care, good faith. Even if you didn't know that, you probably could have assumed that. So profits and losses, the partnership agreements governs, otherwise the presumption in a partnership is they're shared equally. You can't demand distributions. Transfer of interest, so a transferee gets distributions, accounting, and dissolution. The transferor retains all rights, duties, except for distribution. So when you transfer your interest in a partnership, that's what you're transferring, the right to receive distributions. And then they love testing this, that the property belongs to the partnership, not the individual partners. So Tommy and Johnny form a partnership called T&J Lemonade, and they go out and buy a field of lemons. Who owns the lemon field? Them or the partnership? the partnership, right? It's owned by the partnership, it's owned by the entity. So if we're going to add a new partner, that requires unanimous consent of all existing partners. The management of a partnership is equal rights unless the partnership agreement states otherwise. And for ordinary business, you need a majority vote. For extraordinary matters, you need a unanimous decision. Lawsuits, the partners in the partnership can sue each other under the partnership agreement, under the RUPA, right? The Uniform Partnership Act. So yeah, a partnership can sue Susie. Susie can sue the partnership, right? Vice versa, we can maintain lawsuits against partners and against the partnership. I don't know why it does this overlap thing. There's a way I could get rid of it, but I don't remember how. So dissociation, the partner may voluntarily or involuntarily leave. A partnership agreement cannot prevent a partner from withdrawing, but can require notice in writing. So wrongful dissociation, the partner can dissociate at any time, and a partnership unlimited by time or undertaking only when is in breach of an express provision of the partnership agreement. A partnership for definite time or undertaking if the partner withdraws, expelled by court order, bankruptcy, not an individual trust or estate, or the partner dissolved terminates, you're still entitled to receive the value of partnership interest offset by any damages to the partnership if there's wrongful dissociation. So the effect of dissociation doesn't automatically cause dissolution. No, unless it's two partners and then one partner leaves, that would automatically, force the dissolution of the partnership because you need at least two people to continue on as a partnership. A partner as an agent, this is definitely tested. I like the way she does this. Actual authority, the partner can contractually bind the partnership, express the partnership agreement, or the partner states it, or impliedly. That's actual authority, either express or implied. Either it's like you are told that you could buy apples, or it's implied that you can buy apples because we own an apple juice company and you are the managing, the office manager, and the Apple company would think that it's implied that you have authority. And then apparent authority binds the partnership in an ordinary course unless the third party knows of the lack of authority. That's what's usually tested. Some apparent authority theory or inherent authority theory, where it's like maybe they didn't actually have authority. They weren't supposed to buy apples. We weren't doing apples this year. We were doing oranges. But that, Apple Orchard, who sold us the apples, had no reason to know that you weren't supposed to buy apples. So you went and bought the apples. We're going to have to pay for the apples. Typically, like I said, that's the answer, is that the act will bind the partnership. So limited partners. So a limited partner, like I said, a general partner means all the partners are GPs. They all have unlimited liability flow through taxation. An LP means we have at least one general and one limited partner. Could be multiple GPs, multiple LPs, but there has to be at least one of each. So the limited partner has no binding authority, no personal liability, even if participating in management, approval rights on amending the partnership agreement, admitting partners, etc., the right to inspect the business financial records, and can contract business with an LP like a non-partner. A general partner's full management rights combine the LP and responsible for liabilities. So, for all of y'all out there, if you want to just get rich and not have to work, you'd rather be an LP. A GP is the one who's going to mop the floors and, make sure that the business is working. Okay, so corporate formation, the corporation is born. So promoter liability, like we said, personally liable for pre-incorporation. They have fiduciary duty to the corporation, and they may seek compensation, but they cannot compel compensation. Corporation liability, they're not liable for pre-incorporation transactions, even if they're for the corporation's benefit. Exceptions: if the contract was adopted, a contract by accepting the benefits, they gave express acceptance of liability for debt, or novation. They assume liability for the promoter's contract, and all the parties agreed to release the promoter from liability. So once the contract is adopted, the promoter is going to remain liable on the contract. In Florida, all corporations are treated as C corps unless there's an election, and that would be to be an S corp. We already talked about the articles of incorporation, what they must include: the corporation name, the address of the principal office, the number and class of shares authorized to issue, the agent, the name of each incorporator, and the addresses of the initial registered officers, and these are filed with the state. If there's no stock issued, the board of directors could amend the articles. If the stock's issued, then the board of directors adopts amendments or articles, which shareholders must approve by majority. Like I said, if they're shareholders, common shareholders have the right to vote on amending the articles of incorporation because that constitutes a fundamental corporate change. And then bylaws, provisions for management of a corporation's business. They must align with the articles. The articles of incorporation generally take precedence over the bylaws. If there's a conflict between the two, the articles of incorporation will prevail. So we said they have an organizational meeting where they adopt bylaws, they appoint officers. This is what Shakira was saying. They must file with the state the name, the date of the incorporation for annual reporting, the principal office location, the tax ID number, the name and address of all principal officers, directors, and registered agent. Failure to report can dissolve the corporation and bar from bringing court action. So that's what Shakira was saying, that if they don't file the annual reporting, then that can result in an involuntary dissolution, and it's not good. So stock distributions, we talked about common versus preferred. Common is basic ownership with voting on corporate governance. Preferred has preference for distributions. Fractional shares of stock are allowed, most definitely. Most definitely. Distributions are authorized by the board of directors. They must not cause insolvency, right? So you can only make distributions, distribute dividends if you have profits. Sales, shareholders can sell stock to anyone at any price. So this comes up with the idea about appraisal rates, right? Like if there's going to be an acquisition by another company, then the target company, their shareholders get appraisal rates. They get to say, hey, how much are my shares worth? Maybe I don't want to be owned by this company. Maybe I just want to cash out. But you don't get appraisal rights if the company sells on a national exchange, right? If it sells on the New York Stock Exchange or the NASDAQ, you don't get appraisal rights. Why? Because there's designated market makers that stand on the market floor who are buying and selling your stock at any given time. Like right now, I can tell you exactly what my stock in Apple costs. I can tell you exactly what my stock in Netflix costs. You just have to Google it, right? So you don't get appraisal rights if it's Googleable because it trades on the national exchange. Shareholders get the I don't know exactly what that says. Double taxation once at the corporate level and once at the personal level, right? If you sell your shares, you're gonna pay capital gains taxes, long-term or short-term, long-term over a year, short-term under a year. Do you pay taxes on dividends?
Yes.
Yeah, and what type of taxes will you pay?
So also capital gains. No.
Ordinary income, right?
I think it depends, right?
I think it depends too. Don't even worry about that. As I asked that question, I think it's kind of complex, but ordinary income is what you pay on like your wages, and then capital gains is what you pay on your investments. And actually, they're not even going to test that. And I think that's a more complex question than I thought, Eric. So don't even worry about that. Okay. So shareholder meetings, annual meetings, time and date in the bylaws, mainly to elect the directors. Special meetings called by the board of directors or 10% shareholders must state the purpose in the notice. And the notice, shareholders must be noticed of the date, time, and place 10 to 60 days prior, can be waived in writing or by attending the meeting. A lack of meeting doesn't affect the corporation's existence. Voting and approval, so eligibility, record owners, owner of stock of the corporation on the record date set by the, I don't know, people who own stock, right? There's a recording date, there's a payment date, there's a X date, there's like different dates that come into effect about when you can vote, but just remember you have to own the stock to be able to vote on it. A corporation cannot vote on its own stock. In the sale of substantially all the corporation's assets outside regular course of business, the shareholder must approve the sale, right? That's a liquidation event, which is subject to shareholder vote. Approval requirements, general majority, unless the articles allow plurality, and the election of directors, the default is a plurality. So here's a FBB practice questions. I kind of already set this one up. M Corporation's only assets are machines now in storage. One of its directors is approached by a party interested in buying all the machines. Which is true regarding the sale of the assets? The truth is that a majority of the shareholders entitled to vote on the matter must vote in favor before they can sell the machinery. Why? Because they're liquidating all of the assets. Okay, shareholder liability, like we talked about, piercing the corporate veil. The corporate's existence is ignored. The shareholders become personally liable. Florida requires fraud, improper conduct, or illegality under totality of the circumstances. Florida focuses on whether the corporation was used to mislead creditors or perpetuate fraud. the fact that the corporation is a mere instrumentality of the shareholders is not alone sufficient to pierce the corporate veil. There has to be some improper conduct, fraud, or illegality alongside the alter ego doctrine. So factors considered for piercing the corporate veil: thin capitalization, disregard of corporate formalities, using the corporate's assets as a shareholder's own assets, self-dealing with the corporation, siphoning of the corporation's funds, using corporate form to avoid statutory requirements, shareholders' domination of the corporation, or fraudulent dealings with the corporate creditor. So the alter ego doctrine: the court may disregard the corporate entity when the corporation appears to be the alter ego of the shareholders and subsidiaries. The parent corporation may be liable for debts of the subsidiary corporation when the subsidiary is inadequately capitalized or when it's intermingled with the parent corporation. So the board of directors, at least one director. What about a not-for-profit? Do you know how many directors we need for not-for-profit? You need 3 directors. And an interesting fact about a not-for-profit corporation is even a 15-year-old could be a director, one of them. One of the directors could be 15, 16, 17. Like, usually to be a director, you have to be 18 years or older. But in a not-for-profit corporation, they need 3 directors, and one of them could be as young as 15 years old. They must be natural persons, right? An incorporator could be an entity, but the director needs to be a natural person. Directors are elected at the annual shareholder meeting. Vacancies: defendants may resign anytime with written notice or board of directors or its chair, typically, and vacancy can be filled by shareholders or directors. Terms removal is usually 1 year, but can be longer if the director's terms are staggered, and removal by shareholders with or without cause unless articles say otherwise. That's tested a lot, that directors can be removed by shareholders with or without cause. Another thing that they like to test is that the officers can create their own salaries unless it's stated otherwise. So the duties of directors, and just to think about that, directors serve at the pleasure of the shareholders. Officers serve at the pleasure of the directors. So they have the duty of care, duty of loyalty, business judgment rule, usurpation. This is all good stuff right here, right? So the duty to act prudently as an ordinarily prudent person in like position, required to use the knowledge and special skills they possess. The director can rely on info or opinions of owners, employees, lawyers, experts. Business judgment rule to BJR: a rebuttal presumption that the director reasonably believes his actions are in the best interest of the corporation. Does not apply when the director engages in conflict of interest transactions with the corporation. And this could be overcome, the business judgment rule, if there's bad faith, they're not informed, material interest, failed to devote attention, did not investigate, received financial benefits they were not entitled to. And then the duty of loyalty: to act in a manner that reasonably is in the best interest of the corporation. Competition is not allowed. Self-dealing: if a director engages in conflict of interest transaction with the corporation, he violated the duty unless the transaction is protected under safe harbor rule, meaning the disclosure of material facts and majority approval by the board of directors or shareholders without a conflicting interest, so disinterested directors, and the director cannot profit at the corporation's expense. And then usurpation of corporate opportunity: the interest expectancy test, where the corporation has existing interest or expectancy arising from the existing right and the opportunity. And the line of business test, whether the opportunity is within the corporation's current or prospective line of business. So mergers, we talked about: each corporation needs a board of director and shareholder approval by majority of shares entitled to vote. The required documents must be filed with the state, and the surviving corporation assumes liabilities of the corporation that is merged. Remember, think of like the Pac-Man eating the ghost, and now we have a new company on the merger. All right, the articles of incorporation. This is another FBBE question. So a lot of these questions are going to be pretty easy. Some of them are going to be really freaking hard, and that's just the way it is. But I'll tell everyone that the bar exam, if all you want to do is pass, all you got to do is get the easy questions right. It's a low-hanging fruit test. If you get the easy questions right, you have a 25% chance on the other questions. You'll get some of them right too, and you only need like a 55% on Florida multiple choice to pass. You need usually a 62.5 on the MBE and a 55% on Florida multiple choice. This isn't normal, right? It's not like you need to get a 98 to pass this test. You just need to get the easy questions right and, have some educated guesses on the hard questions. That's if you want to minimally pass. If you want to be like some of my students, like Andy and Joel and Robert, these students have scored in the 98s, 94s. Like, they've pretty much gotten every question right. So you can do it, but you don't have to do it. So just make sure you get the easy questions right. The articles of incorporation for number one corporation granted to its board of directors. the power to take any action as authorized by law. Which of the following actions by the board of directors must also be approved by the shareholders of the number one corporation? So this is what's a corporate fundamental change. Extension of the duration of number one corporation if it was incorporated at a time when limited duration was required by law. Merger of number one corporation to another 100%. It's got to be B. Ben, you're right. None of the other stuff would implicate a shareholder vote. So mergers, fundamental corporate change will necessitate a vote. Just see, I told you this test is so hard, right? But these two questions so far are pretty easy if you know the basic law. Liquidation event, we need shareholder approval. Merger, we need shareholder approval. All right, LLCs, we kind of talked about a little hybrid, combines the pass-through tax advantage of a partnership and the limited liability of a corporation. So formation, remember, a corporation will file articles of incorporation. An LLC will file articles of organization. Articles of organization with the LLC, articles of incorporation with the corporation. So signing and delivering the AOI to the Department of State, they must state the LLC name, the address of the principal office, the name, address, and written acceptance of the registered agent. Operating agreement is a lot like the bylaws of a corporation, right? Can override statute unless for key governance like registered agents, dissolutions, mergers, indemnities, and rights obligations of members and managers. Management, like we said, they must have one member at formation, and there could be a member managed LLC or a manager managed LLC. We assume that it's member managed, but if they elect manager managed, then they pretty much have, it's like the officers who serve at the board of directors. These are the managers who serve on behalf of the members. So member managers are not personally liable for the LLC's obligation. They owe duty of reasonable care, fiduciary duties, duties of loyalty, duty to avoid conflicts of interest, and veil piercing applies in egregious situations. Assignment of membership. So the transferee only gets the transferee's right to share in the LLC's profits and losses. Single member LLCs, the creditor can obtain a charging order, making him the assignee of the member's distributions and foreclose on the member interest. And a multi-member LLC, the creditor can only obtain a charging order. They may not foreclose, meaning like they can, if there's multiple members and one member owes them money, then they can pretty much attach to their distributions, but they can't foreclose because there's multiple members. Unless the articles provide otherwise, members have a non-waivable right to dissociate from the LLC at any time. All right. A and D form an LLC and the only members. Andy contributes attractive commercial real estate to LLC. D contributes $150,000. What is true? Andy and the LLC are co-owners of the property. No. Donna and the LLC are co-owners of the property. No. The LLC is the sole owner of the commercial real estate and any property is acquired with 150. Yes, right? Remember, the entity owns the property, not the individuals. That's why they create entities. Your president did a lot of this. Donald Trump, right? He would create these entities that would have these businesses. So that way, if the casino in New Jersey didn't work out, he wouldn't be personally liable because it's owned by the LLC, not by the person. If you're going to go into, property ownership and not just, for personal use, you should definitely create an LLC and put the properties under the LLC. All right, that was pretty cool. That was the PowerPoint. I know what you guys are thinking. Hooray, we're done. It's like I got one more thing to do, and then we'll call it a night. And it's for your own health, but I gotta do this when I have the time. So these are the questionnaires. Let's see if we can do it on our own. If not, we'll have Katya help us out with her outline. So what are the formation requirements for each type of business ending in Florida, and how do they differ? I mean, let's just see what she said. So corporation, you file articles of incorporation with the Florida Department of State. They must name the corporation, the registered agent, the incorporator, shares authorized, and the addresses. The LLC, file articles of organization. They must include the name, agent, members, managers, and addresses. An LP or an LLP, you file a certificate of limited partnership LLP. And for a GP, no filing required, formed by intent to carry on as co-owners for profit. What's a promoter and duties and liabilities does a promoter have? So someone who undertakes for the raising of capital for the company, and they're personally liable on the contracts that are adopted by the corporation, even after the corporation is formed, unless there's an novation. So a promoter is a person who organizes a corporation before incorporation. The fiduciary duties of good faith, fair disclosure to avoid secret profits, and they're personally liable on pre-incorporation contracts unless the corporation adopts them and there's a novation. What are subscription agreements and when are they enforceable in Florida? So subscription agreements are pretty much agreements that people will have to continue to buy stock, right? So pre-incorporation agreements to buy shares, In Florida, they're irrevocable for 6 months unless the agreement says otherwise or all subscribers consent. So that's just a point. I have a birdie question that, addresses this, but yeah, subscription agreements are irrevocable for 6 months. What are the requirements for the AOI? They must include the corporate name, the number of registered shares, the registered office and agent, the incorporators and the addresses. They may include the purpose, duration, limits on powers, and preemptive rights. Preemptive rights are what we talked about earlier, anti-dilution rights. So the same things, the right to maintain your proportionate share. Purpose. If you start a company, you should say the purpose is to do any legal business in the state of Florida, right? You don't want to limit your purpose too much because then you might end up hurting your chances of expansion. So what's the effect of a defective corporation and when can someone become personally liable? So I would say this would be a de facto corporation if you tried but improperly you wanted to file, and I think you can become liable, right? Pretty much. Those acting may be personally liable because the corporation never formed. But de facto corporation by estoppel may protect if there's good faith attempt, valid statute, or exercise of corporate power. What are the statutory obligations of Florida corporations after formation, like annual reports, accounting? I like that. So Florida corporations must file an annual report with the Department of State, maintain a registered agent, and keep books and records, and pay franchise and filing fees. What does it mean to pierce the corporate veil, and when may Florida courts do so? So we're going after the shareholders directly or the parent company. We're going after the owners directly. And remember, there's got to be some improper purpose, some fraud, some misconduct. We can go for the alter ego doctrine. It could be under theory of thin capitalization. It could be, maybe a deep rock doctrine where we're going to subordinate debts in bankruptcy. It could be any one of these reasons for piercing the corporate veil. So courts disregard the corporate entity to hold shareholders personally liable. In Florida, it's only done exceptional cases if there's an alter ego, no separateness, fraud or improper conduct, and undercapitalization or misuse of corporate form. What's the alter ego doctrine? We kind of mentioned this. Corporations used as a mere instrumentality of shareholders, no separation between personal and corporate affairs. It's a basis for veil piercing. What's the deep rock doctrine and how it might apply in bankruptcy? Like I said, deep rock, we're going to subordinate the loans from the insiders and pay off the outside creditors first. So in bankruptcy, shareholder loans may be subordinated to outside creditors if the shareholder dominated the corporation and undercapitalized it. What's the difference between direct action and derivative action? So derivative action is pretty much filing on behalf of the company, and a direct action is pretty much suing the company directly, right? So a direct action, they sue to enforce their personal rights, like voting or dividends, or suing the company to enforce their rights. A derivative action, they're suing on behalf of the corporation, like a breach of the fiduciary duty. They must first make a demand on directors unless the demand would be futile. What duties are owned by directors, owners, shareholders in Florida law? Duties of loyalty, duties of care, duties of good faith. So duties of care, duties of loyalty. Controlling shareholders have fiduciary duty to minority shareholders when exercising control, especially in closed corporations. This duty requires them to act fairly, not to oppress minority interests, and not to use their control to benefit themselves at the expense of minority shareholders. Ordinary shareholders do not owe fiduciary duties to each other, the corporation, simply by virtue of share ownership, right? So I own stock in Google. I don't really owe them any duties. I just need to get paid and vote on things. Okay. What's the business judgment rule? Remember that if a director or officer makes a move that looks dumb, we're not going to necessarily be able to hold him accountable because we have to assume that it was made in the best interest of the company and things just went awry. So presumes directors act in good faith, informed in the corporation's best interest. It protects officers, directors from liability for honest mistakes in business decisions. The corporate opportunity doctrine, how can a director violate it? Like it said, you have to present the opportunity to the company first, but if they give you permission or they choose not to pursue it, then you could overcome it. So directors, officers may not usurp business opportunities within the corporation's line of business unless the corporation rejects them after full disclosure. A breach would be a disgorgement of profits. Sorry. When is a shareholder entitled to inspect the corporate books and records under Florida law? When they want to, as long as it's reasonable and it's at the office and it's within office hours. So right to inspect the records of a written demand made in good faith for proper purpose, must describe records sought and purpose, includes accounting records, shareholder lists, and meeting minutes. One thing I know about inspecting the books. You can't do it on a Sunday at 2 a.m, right? But you could do it on a Tuesday at 3 p.m. When is a shareholder entitled to inspect? Okay, what are shareholders' rights regarding dividends, and when can a corporation legally issue them? They have no rights to dividends unless they're declared. Preferred gets ahead of common. Cumulative preferred will also get their payments in arrears before common. Corporation can legally issue them if they're solvent and they have profits, right? So shareholders have no right to dividends unless declared by the board. Dividends may be paid only if the corporation can pay debts as they come due and the total assets are greater than total liabilities after distribution. And directors approving unlawful dividends may be personally liable. What's the procedure for shareholder meetings and voting under Florida law? I don't know. Annual meetings are required. Special meetings may be called by the board, the holder of more than 10% shares or other authorized. Notice is 10 to 60 days before the meeting. A quorum, as Shakira was teaching us, is a majority of outstanding shares entitled to vote unless the bylaws say otherwise. The election of directors. Directors are elected by a plurality of votes cast. The candidates with the most votes wins, even if not a majority. Ordinary business, ratification of action, approval of minutes requires the affirmative vote of a majority of shares present in person or by proxies or proxies remotely at a meeting in which a quorum is present unless a greater vote is required by the articles or bylaws. And then fundamental changes like mergers, amendments to articles, dissolution require the affirmative vote of a majority of all shares entitled to vote, not just those present, unless the AOI or bylaws require a greater vote. So voting trust and voting agreements, how are they enforced in Florida? So voting trust or voting agreement is like A, B, and C all own shares of Google. And we say, hey, man, every time we vote, we'll vote together. We're a block, right? They can do that. They have to be in writing and they have to vote as agreed, right? So voting trust is a shareholder's transfer of legal title to a trustee who votes shares, must be in writing, signed and filed with a corporation. A voting agreement is a contract among shareholders to vote in a certain way. It's enforceable like any contract. What are the rights and obligations of shareholders during dissolution? Typically, I would say that they get some appraisal rights, of course, unless there's, they're publicly traded. See what else we got. So entitled to residual assets after creditors are paid. They may receive liquidating distributions proportionate to shareholdings. Shareholders may approve voluntary dissolution and appoint liquidated directors. Okay. When does a partnership dissolve and how is it different than a dissociation? So dissociation is when a partner leaves, but the partnership continues. Dissolution, the partnership winds up and terminates, occurs if all partners agree the term ends, unlawful purpose, or a court decree. When may a Florida corporation be involuntarily dissolved? We kind of talked about some of these things. If, it's illegal or there's a deadlock, right? So fraud, abuse, or illegal acts, deadlock among directors, shareholders, failure to elect directors, the shareholders are oppressed, especially in close corporations, and a failure to file annual reports or pay fees. When may a Florida corporation be, okay, what are the rules for voluntary corporate dissolution in Florida? I mean, they can pretty much do it. So it requires board resolution, shareholder approval, right? After approval, file articles of dissolution with the Department of State, and the corporation then winds up business by paying debts and distributing remaining assets. What's a non-for-profit corporation? How is it different than a regular corporation? It's literally not for profit. So they, they can like pay salaries and wages and stuff, but they just can't pursue a profit. Like we said, we have to have 3 directors and one of them could be as young as 15. So no shareholders member. Instead, they cannot distribute profits to members. Instead, assets are used for charitable, educational, religious, or social purposes. What types of fundamental changes require shareholder approval? Hopefully you guys learned this from today. Remember mergers, acquisitions, liquidation events, dissolution events, stock splits, amending the corporate charter, and then of course electing the board of directors. So amendments to the articles, mergers, share exchanges, sale of substantially all assets, dissolution. What appraisal rights do dissenting shareholders have in Florida, and what is the process? So your appraisal rights are like you get to see how much your shares are worth. Like I said, you don't get appraisal rights if the company is traded on the open market. So dissenting shareholders are entitled to fair value payment if they object to fundamental changes. They must give written notice before the vote, abstain or vote against, and make a timely written demand after the vote. We talked about merger, share exchange, sale of assets, how they're treated under Florida law. So a merger, 2 corporations combine and 1 survives, requires board and shareholder approval. Share exchange, 1 corporation acquires shares of another, similar approval. And sale substantially all the assets requires shareholder approval, but not dissolution. what are preemptive rights and how are they automatic in Florida? Like Stina was saying, these are your anti-dilution rights, your right to maintain your proportionate stake in the company. I do remember when I took the Florida bar, there was a question about this. So make sure you understand that preemptive rights, anti-dilution rights. Right of shareholder to maintain percent ownership by buying new issuances. And it's not automatic in Florida, it must be expressly provided in the articles. Okay. I didn't necessarily know that, but it's pretty much every company has anti-dilution rights, but it has to be provided in the articles, and it typically is. What is long arm jurisdiction? How can Florida courts exercise jurisdiction over foreign corporations? So long arm is, the minimum contacts test where they could hail a company into court. Over foreign corporations, well, let's see. Florida courts may exercise PJ if a foreign corporation does business in Florida, commits a tort in Florida, owns, uses, or possesses property in Florida, contracts to insure in Florida, or otherwise falls within the enumerated acts. Florida blue sky laws, how they differ from federal securities law. Remember blue sky laws? What are we looking for? What do blue sky laws regulate? I forget. Does anyone remember?
State.
Intrastate
State.
securities, exactly, right? Intrastate securities. So require registration of securities offered in Florida unless exempt. What are some examples of exempt securities that don't need to register? I mentioned this. What's one example? It's exactly what you would suspect, right? Like what's an example of a type of company that doesn't need to register with the SEC if it's interstate, or under blue sky laws if it's intrastate? They're exempt. What's an obvious
Pardon?
example? Go ahead, Shakira. Go ahead.
Would it be a partnership?
Well, that's not a corporation.
Oh, like a corporation. Sorry, I thought you meant like what type of organization.
No, fair enough. Partnerships don't have to register under the SEC. That's for sure. But I'm talking about a type of corporation that is exempt from registration. It's exactly what you would think it is, right? Charitable, religious, municipal, these types of companies. Okay. So require registration of securities offered by Florida unless exempt. Protects against fraud and security sales, different from federal law because it focuses on intrastate transactions and small offerings. Where federal law, does anyone remember what rule regulates the registration of securities? It's a year,
1933.
1933. That's the year. What is insider trading and what duties apply to the special facts doctrine? Insider trading is a breach of fiduciary duty using material non-public information. And the Florida special facts doctrine, directors must disclose material facts when dealing with shareholders or rescission damages may follow. What is 16B and what does it require? Does anyone remember what 16B is? This is on my PowerPoint. I'm like, yeah, it's on my PowerPoint. Kaya didn't even put it. No, I'm just kidding. I love Kaya. She's a monster. She does like 45 hours of tutoring a week for IBIS Prep.
The 10B?
No, 10B5 is this question. I'm asking this question. What is 16B?
Oh, 16B. I have it written as 10B, but isn't that the one where it's any officer, director, or 10% shareholder is liable for short-term profits starting at 6 months?
100%. So the federal rule that insiders, officers, directors, 10% shareholders must disgorge short swing profits from buying some public corporate stock within 6 months, strict liability, intent, and relevance. So right now, it's hella officers and directors and 10% shareholders of SpaceX who are sitting there like hoping that that should stay super high. And then after 6 months, they're going to sell it and they're going to dump it on all of our heads. And that, my friends, is life. So what is SEC Rule 10b-5 and what elements must be proven for liability? Does anyone remember what 10b-5 relates to? I totally forget. Can someone give me some insider information on this one? Little dad joke for you, all right?
Trading.
Yeah. So it prohibits fraud, misrepresentation in connection with the securities purchase and sale. The elements are misrepresentation, omission of material facts, scienter, reliance, causation, damages, instrumentality of interstate commerce. So yeah, this is the tippy rule is 10b-5. Ooh, a tender offer. So a tender offer could be like a takeover, it could be a hostile takeover. This stuff is cool. So a public offer to buy shares from shareholders at a premium. It's governed by the Williams Act, the 1934 Exchange Act amendments, and requires disclosure of identity, financing, and purpose. Like I said, 1934 is the People's Act that regulates broker-dealers. How is agency created and what types of authority exist? So actual, apparent, inherent. Actual is either express or implied. Apparent means like, okay, you worked for, I'm not going to put anyone, but let's say Tommy used to work for IBIS Prep and I fired Tommy. and said, Tommy, you're fired. I don't really fire people. I give people 7 chances. But let's say I fire Tommy. And then Tommy goes and transacts business with Susie, and Susie has no reason to know that Tommy doesn't work for me, and I never announced his firing or anything like that. That would be apparent authority. It wasn't actual or implied, but it was apparent. And then inherent authority is like, I'm the manager for Justin Bieber, and someone calls me and says, hey, would you want to book this venue? And I say, yeah, like, let's bring the Bieber out. I have inherent authority based on my job, right? Like it's kind of implied in my job. So, okay, requires consent of principal, consent of agent, controlled by principal. So authority is actual, express or implied, or apparent, the principal holds out the agent, or inherent, the agent does acts usual for the position, right? The Bieber manager books venues. That's inherent. When is a principal liable for the torts of an agent? So, usually, always, right? Unless it would be some sort of thing outside the scope of business, unless it's kind of their job. Like if I own a club and the bouncer is my agent and he punches someone in the face, I'll be liable because that's part of his job, right? I'm not sure if this is getting at disclosure, but on the other way around, an agent is not liable for contracts on behalf of a principal if the principal is fully disclosed. But if they're partially disclosed or non-disclosed, then the agent could be held liable. So in response superior, the principal is liable if the agent is an employee, not an independent contractor, and the torts committed within the scope of employment. Independent contractor, the principal is usually not liable except for inherently dangerous activities or non-delegable duties. So what duties do agents and principals owe to each other? Agents, duty of loyalty, duty of care, principal, duty of recompense, right? Like if, Tommy goes out and buys, I don't know if you guys know, but we got brand new swag, IBIS Prep hats. If Tommy goes out and buys these IBIS Prep hats, then I got to pay him for the hats, right? That's recompense. So let's see what we got here. Reimbursement, okay. Loyalty, care, obedience, accounting, disclosure, and compensation, reimbursement, indemnification, safe working conditions.
Even if he doesn't ask you,
Wait, so who doesn't ask who?
Tommy doesn't ask Andrew.
Yeah, because if Tommy goes to the store and buys a bunch of hats on behalf of IBIS Prep, well, he has the authority to do that, and I'm gonna have to compensate him for it because it's either implied or inherent or apparent. There's some sort of authority that would bind me to it because it's within the scope of business. Now, if Tommy goes out and buys a bunch of like pickle jars for pickle eating and we don't have anything to do with food, I might not be liable for that because it was outside the scope of business. What's the difference between a detour and a frolic? So I feel like some of Stino's questions are actually frolics, but some of them are just nice detours. Very rarely they're right on point, but they're still entertaining. A
Wait till
detour
my
means
next
like
one.
okay, fine. So a detour means that like you're driving and you're delivering pizza for me, and then you go have a cup of coffee, and while you're having coffee, you accidentally run into Susie. That would be a detour, getting a cup of coffee while working. A frolic is, hey, you're delivering pizzas for me, and then instead of delivering the pizza, you go to your girlfriend's house 3 towns over. You guys, watch the football game, drink a bunch of beer, and then you fall out on the street and someone trips on you, something like that. That was a major frolic, right? All right, what's the difference between employee and independent contractor? Employee, an employee is a W-2 and an independent contractor is a 1099. Employee means like it's not so clear. Like I say to y'all, everyone who works for me is an independent contractor. Some of you guys could probably argue that I have employees, even though they're not, W-2 employees, they still, are under my control. They work a salary, they work regular hours, XYZ. We're an independent contractor, someone who, for IBIS Repair Group, a lot of our technicians are clearly independent contractors. We'll just call them up and be like, yo, Tommy, I need you to, seal the roof, right? They don't show up in the IBIS Repair shirt. They show up in their own shirt and do their own thing. No logos of us. That would be an independent contractor. An employee, there's some ways that they could be considered employees. So, employee factors control over work, tools, duration, method of payment, whether work is integral to business. The employee is principal liable for torts in the scope. Independent contractor, no vicarious liability except for non-delegable duties and inherently dangerous activities like blasting. If we were doing a demo and we were blowing up a house and Susie, who worked for me, blew up Tommy's finger, that would be a non-delegable duty. And what did Shakira say? Tommy can get branded pickles for the care packages. Yeah, If Tommy got branded pickle jars, then sure. Okay. Damn, the last question. I was having a lot of fun. I thought we were gonna go to 10 p.m. It was gonna be the longest Irish prep class ever. I don't know. I like this class. It was better than my MBE civil procedure class when I took the Brightline train, that's for sure. So what is a business trust and how is it formed and operated in Florida? Let's see. A business trust is created by a written declaration of trust filed with the Department of State. The trustees manage property business for the benefit of certificate holders, the beneficiaries, and is treated as a legal entity like a corporation for suing or being sued. One question they asked about business entities that I can recall is what if there is a corporation that hasn't, filed with the Secretary of State yet? Can they sue?
No, but they
But
can defend the lawsuit.
they can be sued, right? They can't maintain a proceeding, but they can defend themselves. So they like to test that. I'm telling you, if you go on Birdie, you do the questions, and especially the FBB questions, you'll see a lot of these questions are reasonable, and you can get to the bottom of it. We got a master outline you guys can look at, could be fun. A tax sheet, the Barbie questions I recommend you'll do, additional materials, some more videos, some more, outlines, all sorts of stuff. I think this is a really tough subject, but I think that you could use your investing brain to get some of these questions right by just, putting yourself in and be like, hey, if I owned shares of this company, what would be best for me? I know I'm going to regret this, but Stino, what was the question you had? You said you had one question for me?
I put it in the chat. It's so stupid, but it's low key a good question.
Okay. I'll be the judge of that. What's the question? Oh, you're
Oh,
putting it in the chat. Okay.
it's
Okay,
already
this
in
might
there.
be this might be my stupid question. But is it false representation if you tell a girl on a date that you are an owner of Apple when in reality you have like 500 invested? Technically not lying though. Okay, that's a good question.
Oh,
Why is that a good question? Because what is a necessary element of prevailing in a misrepresentation claim? What do you need to prove?
you need to
Damages,
prove.
exactly what you
Yeah,
just said.
yeah.
Junior proprietary, yeah, there's got to be some loss here. So what's her damages? Right? Like that's what I'm saying. Like, yes, you misrepresent. You're not I don't know. I don't think that I would want you to date my daughter if that's how you acted, but you're not going to be liable for the tort of misrepresentation or the breach of contract claim of misrepresentation unless there are damages. So they asked that on the MBE, and that's like, Tommy misrepresented the hell out of everything, but then Susie was able to sell the thing that she thought was something else for the same price she bought it for. There's no claim there because she didn't suffer any losses. So there would have to be some damages that were suffered. And then Eric is talking about qualified dividends. I'll just read this because it seems interesting. So qualified dividends, which come from domestic or qualified foreign corporations and are subject to specific holding period requirements, are taxed at this is about the taxes, are taxed at a lower long-term capital gains rate. This rate is generally more favorable than the ordinary income tax rate and can range from 0% to 20% depending on your income bracket. Ordinary dividends are taxed at the higher ordinary income tax rate. That's what I was talking about, ordinary dividends, right? They're taxed at ordinary income, which is the same rate applied to regular salary or wages. This can be significantly higher, especially for those in higher income tax brackets. Understand these tax implications is crucial for optimizing your investment strategy and minimizing your tax liability. I mean, in general, quick tax law, ordinary income, you pay a lot of taxes. Short-term capital gains, just to pay a lot of taxes. The least amount of taxes you'll pay would be long-term capital gains. So if you want to pay the least amount of taxes on something, you should hold on to your investments for over 1 year. There's one type of bond that's triple tax-free, a bond that you don't have to pay any taxes on, not federal, not local, not state, nothing. Does anyone know what bond that is?
Not a muni.
Yes, municipal bonds. Municipal bonds are very tax effective instruments. They don't generate that much money, but they're tax effective. And just tying this into Florida con law, Florida real property, if you will, what are the two types of municipal bonds that are commonly issued? I don't know why you made that face, Tenny. We know this. It's part of con law, real property, if you will.
What, general and obligation bonds?
Yes, GO bonds and REV bonds, general obligation bonds, which are backed by the actual, general obligation bonds, which are backed by taxes and subject to municipal vote approval. And then revenue bonds, REV bonds, which are backed by the actual revenue of the project and are not subject to a vote, but are subject to feasibility studies. So you think of a revenue bond like a toll bridge, if we're gonna, issue bonds to build a toll bridge, and we would think of GO bonds, general obligation bonds, like a park or a public school that's not going to generate revenue, but it's going to be paid for by taxes, and that's why you would require a vote. I know that, we burn the midnight oil, if you will, for Stino. It's like early in the morning for him. But yeah, this was a good class. I hope that I helped you guys with business entities. Remember on Saturday, I'm going to do all the business entities questions on Birdie and also the secure transactions and the commercial paper ones. On Wednesday, I'm going to come back and do secure transactions and commercial paper. I promise you from the bottom of my heart, those two subjects are way easier than this subject. People have this like fear that commercial paper and secure transactions are super hard, super difficult, but the truth is they're actually pretty basic, and the way they test them on the exam is pretty easy. This subject, business entities, I think is really tough, especially corporations and the like. But if you're super scared of secure transactions, commercial paper, just come to my class on Wednesday. I'll explain the fundamentals and we'll get through that together. And then on Saturday, we'll do the workshop where we do all the Birdie questions for business entities, commercial paper, secure transactions. It's going to be another long class for sure. If you're in my MBE class, I will be seeing y'all tomorrow, 7 p.m. We're doing proctored exam, right? We're going to do the Birdie proctored exam for MBE tomorrow. So that'll be nice and fun. And then if you're in the boot camp, I'll see you tomorrow, 10:30. You'll be doing, if you're Florida students, you'll be writing 3 essays. So for those of you who are not in the boot camp but want to maintain what we're doing, we're going to be writing essays tomorrow. So it'll be a lot of fun. Again, really appreciate everyone for hanging out with me. I'm going to go ahead and stop this recording.